Hi everyone, welcome to this first episode of Beyond the Markets, where every week we will break down the biggest financial and geopolitical news, analyze stock charts of the major indexes, and look ahead at what's coming next, and this from an asset manager's perspective. This week we've got the US-Ukraine deal, which had major economic implications, Germany's election, Trump's new tariffs hitting key industries, and Nvidia's earnings, where we question if the AI boom is still going strong. Let's get started. So with that, let's look at our first segment, which is the US-Ukraine agreement. Trump and Zelensky met and it got tense, very tense. Trump told Zelensky outright, "Without our military aid, Ukraine would have lost in weeks." There is clear tension between Trump and Zelensky, and Trump accuses Zelensky outright of gambling with World War III. The resource deal would mean that Ukraine hands over 50% of future natural resource revenues to a US managed fund. In addition, this would mean that there would be no security guarantees for Ukraine, so this is a very tricky deal. To be mentioned, mining takes on average around 18 years to be profitable, so it would take a lot of time for the US to even see revenue from this. Market impact wise, this would have a big impact on potential energy and mining stocks, especially if they have Ukrainian exposure, and this would drive geopolitical tensions much higher, particularly in oil. In our second segment, we will take a look at Germany's elections, which happened last weekend. This caused a political shift in Europe. In particular, the CDU won the elections by 28.5%, but they still need a lot of coalition partners to form a government. The far-right AfD surged to 20.8%, showing a rising discontent. This is a similar trend as we have seen across Europe, and in the large economy of Europe, this is quite a big deal. In addition, the SPD collapsed to 16.5%, which is their worst result ever, considering that we have Olaf Scholz currently already stepped down a while ago. This is a major blow to the SPD. In addition, there are plenty of problems within Germany. They are currently suffering from economic stagnation. And what does this mean for the market? Well, if Friedrich Merz from the CDU is able to form a stable coalition, which is business friendly, this could boost German equities and overall European equities by quite a bit. But if political gridlock continues, we can expect a euro weakness and further market volatility across Europe. It's really important to realize how weak the European economy currently is. In addition, industrials and auto stocks, like Volkswagen for example, could react significantly depending on the new policies. Volkswagen is currently very weak, and we also have Stellantis, which has been weak across the board for over a year now. It is important to realize that Germany was highly dependent on Russian gas right before the war. So if this continues, energy costs could rise and the consumers and the overall public will be in much discontent, which could further fuel the AfD. In addition, it is important to mention that the far-right AfD has been known to have quite some relationships with Russia, although they have denied this in the past. Now let's move forward to our third segment, which are Trump's tariffs, which could mean big trouble for pharma and autos. When we take a look, we can see clear tariffs on pharmaceuticals. This could be 10 to as high as 25%. It's important to realize that the US imports 72% of drug ingredients from abroad. So this could mean higher costs, which would mean higher prices for medication, which could cause inflationary pressures. For some companies, for example, like Eli Lilly, are currently investing in US production, but it can take quite a lot of time to get this production to scale. It's important to mention that we have the DOGE under Elon Musk, which is cutting government expenses, which could counter these inflationary pressures quite a bit, but will remain to be seen what the effects are, and we won't see them in the immediate term. It could take quite a while. When we look at the auto tariffs, we can see them being as high as 25%. This would majorly target European and Asian automakers to favor US production. Companies like Volkswagen, for example, and Toyota face supply chain disruptions and cost increases. So who are the potential winners out of this? The US automakers like Ford and GM. But this is at the cost of higher car prices for consumers. So we will see how these stocks react, and in particular how European stocks will react, like Stellantis, which stock has already been quite depressed for over a year as it has had structural issues. And as our last news topic, before diving deeper into the indices, we have Nvidia's earnings. Is the AI boom still going strong? That's a question. Nvidia crushed expectations once again. Revenue came in at $39.3 billion versus the $38.1 billion that was expected. Data center revenue was up 93% year over year. AI demand is massive and remains massive, according to CEO Jensen Huang. He sees strong demand for the Blackwell chips. Nevertheless, the stock market was quite underwhelmed by the guidance that Jensen Huang gave. The stock dropped 8.5% in one day after the earnings were released. Nonetheless, the market recovered quite a bit of that in the last trading session of the week. Before diving deeper into the technical analysis of the SPY, the Nasdaq, and the Russell, and even the Euro Stocks, we have this chart from the compound. This one is interesting because it shows that there were never this many bears in the stock market after a 3% drawdown. This shows that sentiment is currently really bad, with 61% of the people being bearish. This is a very strong indicator and has shown to be quite trustworthy in the past. Now let's take a look at the technicals, starting with the S&P 500. We will take the SPY as a proxy for this one. The SPY closed the week down almost 1% after we had quite a volatile week, with the SPY reaching as low as 582.44. The high of the week was 603, with the market closing at around 594.18 for the week. When we take a look at the 1 week straddle prices, we saw that there was quite a huge difference. The 1 week expectation on the call side for next week is 605.93, with the 1 week put side being at 582.39. In addition, we took a look at the open interests, both on the put and call side. And surprisingly, we can see that the most open interest was on the 590 strike. Remember, both the straddle and the pin is currently focused on 7 DTE, as the pins were on the 509, as the 7 days till expiration pin on both the put and the call strike were at 590. This will be quite a strong level to surpass, and this is fairly close to the max pain. So we could see the SPY gravitate to this level this week, or at least test it. The Nasdaq on the other end had a really tough week, closing down almost 3.4% for the week. The high of the week was 21.7k and the low of the week was 20.4k, with the Nasdaq closing at 20.88k for the week. We can also see that the Nasdaq is currently below its 10 and 20 week moving average. This could mean that there is potential more downside ahead. In addition, the Nasdaq is currently down almost 6% in just 2 weeks. The 50 week moving average on the other hand still is quite a bit lower at around 20k. This means further downside pressure could be in the making. It remains to be seen. The Russell 2000, which we use as a proxy for small caps, was down just over 1.5% for the week, but the Russell has been in shambles for quite a while. It has dropped almost 14% of its high, which it made on the 25th in the week of the 25th of November. Now, with the Russell being below its 50-week moving average, there is quite some potential downside ahead. Nevertheless, it made quite a strong bounce on Friday. But in the long run, if you have a long enough time horizon, this could actually be quite a strong buying opportunity if you are still willing to endure more pain. Because with a recession, this could potentially drop much lower, of course. We will also take a look at the VIX, also known as the volatility of the S&P 500. The VIX is up over 30% in just 2 weeks. This shows how volatile the market has been these last 2 weeks, which is to no surprise, with Trump coming out with a new statement pretty much every day. Last but not least, we take a look at the Euro Stoxx 50 cash index. It's amazing how hard this one has rallied this year, with it being up over 13.5% since the beginning of this year. This is very strong compared to its US counterpart, which has seen quite a bit of struggle during February. The Euro Stoxx 50 cash index closed the week at 5.46k. It made a high at 5.53k this week, with the lowest point being 5.387k for the week. Alright, that was it for this week's Beyond the Market. If you enjoyed this breakdown, make sure you like, subscribe and hit the notification bell so you don't miss out on next week's deep dive. What do you think? Is a potential US-Ukraine deal fair, although it's currently off the books? Will Germany's elections impact Europe? And do you think that Nvidia is still a buy, or is it currently overvalued, even after the significant drop it had? Drop your thoughts in the comments. Thanks for watching and see you next time.